Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. It is September, or
Yes.
as I suggested that we call it in our WhatsApp chat, we should launch Super September,
Yeah.
where every September we try and get people to check in on their super. You were pretty lukewarm on the idea. But I'm hijacking the start of this episode to say, even if Bryce doesn't embrace it, let's all take September to check in on our super. What fees are we paying? Are we in the the right allocation of aggressive, conservative, or moderate? And can we do a quick check and see if we have any duplicate super accounts out there?
Nice.
Super September, it's a thing.
What if I've done all of that because I've just listened to the 4 multiple part series and many episodes we've done on Super in the past?
Great. Just do it again. It doesn't take long.
No, well, I like your
And
original
then-
idea, which was use this month to do as many additional
Yeah,
contributions.
that
as
I
you
think
can.
is where
Yeah.
Super September will go in future years.
Yeah, that
whereas
was
we
good.
use the month of September to try and max out our concessional contributions for the month.
Yeah.
How do we allocate more to Super?
Yeah.
Just for a month. You don't have to do it all the time, but just for 1 month, let's try and get more in there.
Yeah. Well, not even max out, but like the ways that I would think about doing that is maybe divert what I would be putting into my core and satellite.
Yeah,
for
yeah,
example.
just for 1 month.
Just for one
Yeah,
month.
yeah,
Just
yeah.
go, I'm going to put, that money into Super. And that's it.
So this is from Little Things, Big Things Grow from the start of one random podcast episode. We want to make this a thing. Super September. Everyone check in on your super. But let's get into the episode because we've got a lot to cover. We've got some big news stories. Just like most of our friends, REA Group is also moving to London. We've got a community questions on small cap indexes and why we don't love them. And then finally, we're launching a new segment, The Business Of, where we take a deep dive into a particular business to understand how it works. And with the news around the NFL allowing private equity ownership, we thought this would be a good one to start with, The Business Of Pro Sports Teams.
Yes. Looking forward to getting to that. But let's kick off, as always, with news.
News and markets.
So REA Group, the owner of realestate.com, they have announced that they're considering a takeover for one of UK's largest real estate platform, Rightmove.
Yes. Now, for context, realestate.com.au is a giant here in Australia. It is the dominant real estate platform, realestate.com.au. Second is Domain, but Domain is clearly second. REA Group has expanded overseas before. It's in the US with Realtor.com.
Yeah.
And then it's in a number of Asian countries with a couple of different platforms. It's in India. It's in a few different places. But it's not in Europe. This move would be a big move for it. REA Group is currently valued at about 27 billion Aussie dollars. Rightmove is about 4.5 billion British pounds, or about just shy of 9 billion Aussie dollars.
I hope this doesn't become a story of Australian business doing really well, tries to expand and the Australian business suffers.
Yeah, there's a long history of that. isn't
Long
there?
history, yeah. And so I hope that, because shares fell 5% on the news, but, I mean, it's a chunky takeover, $9 billion.
Yeah.
I can see why they want to do it. If you're going to expand overseas, why not just buy the biggest player and get it into the business? But we've seen time and time again where this does happen, and the Australian businesses, which has been touted for years as just this beautiful business.
Yeah.
The Australian business suffers. So, yeah, it's an interesting one.
Aussie companies struggle to go to London for some reason. Like, Aussie companies seem to have had a lot more success going to America or to Asia. I mean, the obvious one that comes to mind was Bunnings buying the hardware store over in the UK in 2016. By 2018, they were out. Yeah. There's been a few that have struggled. I think this is an interesting... So I'm an REA shareholder, have been for a while. love it. It's an interesting proposition for a couple of reasons. But how about this?
Okay.
So I had a look at their financials. So REA is bigger. REA did 1.35 billion in revenue.
Mm-hmm.
Rightmove did 364 million pounds in revenue. So call it about half in Aussie dollars, 700 million Aussie dollars.
Yeah.
But how about these profit margins? So REA's profit, 461 million, gives it a profit margin of just shy of 35%.
Yeah.
Rightmove reported underlying profit of 265 million pounds.
On 364
million
wow.
revenue, which gives it a profit margin of like 70%.
Yeah. Wow. Well, no wonder they want to acquire them.
And I think, like,
different market.
so there was an American company that has bought the third largest UK player, but I kind of like this from REA being like, let's just buy the largest player.
Yes.
Like when when we talk about Australian companies expanding overseas and not having perhaps a great track record, it's rare that it's just like, we're just going to go to a bigger market and buy the biggest established player. So it is a bit of a different story. And you always have to wonder as an REA shareholder, like, what is the growth opportunity in Australia? Like, there's always adjacencies that they can sort of push into, but it's like, there are just bigger markets where there's bigger opportunities.
Yeah. Well, we'll certainly watch to see how this one unfolds. No one loves a property more than Australia, though. So,
True. But
anyway,
yeah.
Let's keep moving. Ren, the tension is building between Australia's private hospital operators and private healthcare insurers over who should cover the growing costs of healthcare in Australia.
Yeah, this is an interesting one because it's not directly investment related, but so many of these players are listed Aussie companies, and this is going to become a problem.
Cue a push to our recent deep dive on the healthcare industry.
Yeah, that's probably why it was front of mind when we were reading this story. But there's just a few stories that have popped up in the last month that when you sort of put them together, you realize there's a bigger challenge brewing.
Yeah.
And the bigger challenge is fundamentally that the cost of healthcare has exploded recently. So many new treatments, so many new innovations. Australians, people around the world are living longer. The majority of healthcare costs comes in the last few years of life. There's just like a growing cost burden, and there's a real challenge about who shares it.
Yeah.
So the story is that Australia's largest private hospital operator, Ramsay Healthcare, has said it may now start refusing to deal with health insurers that don't agree to cover a bigger proportion of surging healthcare costs.
Yep.
But Ramsay isn't alone, because just in August alone, just in the last month, St. Vincent's, which operates about 10 private hospitals, not-for-profit hospitals, almost walked away from a deal with NIB, the insurer. That one stood out to me because I'm with NIB.
Same. Yeah.
And then Uniting Care in Queensland threatened to walk away from a deal with Australian Health Service Alliance. Now, that name probably doesn't sound familiar, but they represent like 22 health insurers. They're like a big player in the space. And so what this makes me think is if this keeps going this way and the private hospital operators follow through on their threat, we might sadly get to an American situation, which is where you have in-network and out-of-network hospital operators.
And so just to be clear on that, you're saying that St. Vincent's, as an example, if they don't get a deal with NIB, they would be out of network.
Yeah, and so if you wanted to go
to St. Vincent's, you would have to be with the insurers who are aligned with their network.
No, they just don't take your insurance, so you just got to pay out of pocket.
You just pay out of pocket.
Yeah, right. Or you go to an in-network hospital.
Right.
That's the American,
which is not where we want to get to.
That's the American system. The American system is cooked in so many ways. And I don't think Australia is close to that. They'll sort these disputes out. I think this is a bit of posturing in the media, negotiating tactics, all of that. But it is a problem. And the problem is exacerbated by a number of things. Like, one, that costs are surging, and that two, that private health insurers, they have their premium increases capped by government.
Yeah.
But the hospital operators are saying, you can actually just see, because so many of these companies are publicly listed, you can see that their insurers' profitabilities have expanded as private hospital operators' profits have contracted, and they want to push that
Squeeze.
I'm thinking like the thing that swings, the pendulum back the other way.
Yeah.
So yeah, this is just like a watch and see, especially if you're invested in private health insurers or private hospital operators.
Well, an AFR article headline grabbed my attention earlier this week. It said it was off the back of a preliminary report from the federal government who have come out to say that private hospitals are uninvestable.
Yeah, right. Okay.
Yeah, and that more will close, all because of the increasing costs of delivering medical treatment, and profit margins are just getting absolutely crunched. So much so that they reckon a bunch are actually just going to start closing.
So this isn't a uniquely Australian problem. Like healthcare costs are rising around the world, and hospital systems are struggling to figure out how they're going to pay for it. And this is the Australian version of it.
Yeah.
So.
If you want to keep up with the business headlines, make sure you subscribe to our daily newsletter. We'll put a link in the show notes and comments below if you're watching on YouTube. We'll send you the important headlines that matter every day in your inbox, plus questions from the community that are answered by experts.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
All right, Bryce. So we've got a question from the community. I think about a week ago, you said as a throwaway comment when you were talking about...
It wasn't throwaway, but yeah.
Okay. Well, you said as a passing comment,
yeah.
As in like we didn't explain it, your investment in an active small cap manager.
Yep, fair right.
You made a passing comment that got tongues a wagging, people are talking, and Daniel sent this message in.
Hey, Bryce and Ren. I've got a question for you guys from Monday's show last week. You said investing in a small cap index is not the way to go when you want small cap exposure. And I was just wondering why that is, if you could give me a bit more info on that. Cheers, boys. Love the show.
Thank you, Daniel, for the question. Just a reminder before we answer it, if you have a question you want us to answer or an expert to answer, the best way to get it answered on the show is to record it as a voice note. The link is in the show notes.
Yes.
So, Bryce, do you want to kick it off?
Yeah, look, I can understand why this might be confusing given how often we talk about the positives of investing in the index,
yes,
and why taking the index is often more than enough.
Some argue that we speak about it too much.
Yeah.
We're
the index boys, not the island boys.
Oh, that is a rich vein of content right there.
But when it comes to investing in indexes in the small cap market, there are two major problems. The first is that big companies that are falling, they fall into these indexes. Yeah. And the small companies that are rising end up rising out of the index. And so what you're left with is an index of good companies that are becoming worse and small companies that are becoming better, and then they all leave.
Yeah. And I think you said that the first problem, big companies are falling and they fall into the indexes. They fall into the biggest positions on these indexes.
Yes.
Because they fall into the top.
Yeah.
And you don't want that, because then your biggest holdings in those indexes, the ones that will ultimately move the indexes more than the smaller holdings, are on a falling trajectory.
Yeah.
Yeah.
And so I get it. Like conceptually, when you're first starting out investing and you think, I want access to the small caps, but I don't want to make the decision about choosing which ones, you naturally think, getting the Russell 2000 or whatever it is, the 2000 small caps, it makes sense. Then I'm just going to get them all moving together. But 1,500 of them might be garbage.
Yeah.
And you're not really actually getting the quality companies within those 2,000, which is why, back to that episode, I've chosen to get active management in this space.
I think the thing that we've learned over the journey, we might be the index boys, but small caps and emerging markets, if you want to play in that space, you have to go active management.
Yeah.
And you don't have to play in that space. I think that's important to say. Like, you can build heaps of wealth, large caps, indexes, developed markets, you're all good.
Yeah.
But if you want small cap exposure and emerging markets, either you need to be discerning or you need someone to be discerning on your behalf.
Yeah.
And I think if we go back to like the first principles of indexes, why they're so powerful, we've been doing this series with iShares by BlackRock and we've been calling them elegant.
Yeah.
Like, let's just stop and think about why we like large cap market weighted indexes. First of all, they give you more of the good and less of the bad through these rebalances.
Yeah.
But small cap and medium cap indexes don't do that. They don't rebalance to give you more of the good and less of the bad because of what we just spoke about. The great companies rebalance out of an index, and companies that are falling will rebalance into an index.
Yeah.
So like you often will get more of the bad and less of the good. So that's one. The second thing that we really like about indexes is that you can cut your losers completely. Companies that are falling or just are not keeping up with the overall growth of the market will literally fall out of the index. The ASX 200, if you fall out and you're the 201st company, we no longer own you. We no longer want to hear from you. But that's not the case with small cap indexes, like unless you go really tiny. But you can fall a long way before you fall out of a small cap index. And then the third thing is that large cap market weighted indexes like the ASX 200, you capture the majority of a company's growth for those like few generational companies that like move the whole overall market forward. You might get in at a couple of $100 million market cap. And as you go to a $20 billion company, like we spoke about REA earlier in this episode, like the majority of their growth journey, they were in the ASX 200, and people who invest in the ASX 200 got the benefit of that.
Yeah.
And that just isn't the case with small cap indexes. Like to extend the REA Group analogy, you might get its first couple of $100 million of market cap when it's a small and then a mid cap, but it eventually graduates out and goes into another index. So you miss out on the majority of those great companies' growth.
Yeah.
So for those three reasons, I would say everything that makes large cap market weighted indexes so great is not present with small cap indexes.
No. So let's put some examples to this. So there's the S&P ASX Small Ordinaries Index. It's returned 5.84% over the past 10 years. If you compare that to the ASX 200, 7.9% in the same period.
Yeah, and that's not including dividends.
Yeah.
And obviously the ASX 200 is pumping out more dividends than the small
Definitely.
ords.
Then there's the US Russell 2000, one of the most well-known small cap indexes over in the States. It's returned 7% for the past 10 years, but the S&P 500 is 12.9% in the same period. And then the MSCI UK Small Cap Index, 1.8% for the past 10 years per annum. And the FTSE 100 has returned 6.2% for the past 10 years.
Yeah, so that's Australia, the US, and the UK, and a similar story emerges there. And look, like, don't get us wrong, like the small cap indexes are generating growth.
Yeah. You could look at those numbers we just said and said the Russell 2000 7% for 10 years.
Fine. That's
great.
good. That's good. It's just that the large cap indexes outperform because they're more fit for purpose. They're more fit for the index style of product than small caps.
If you were to look at, I would imagine if you were to look at some of the best performing small cap managers, or even that there'd be outperformance there.
Honestly, as we were putting this episode together, all I was thinking was if I ever became a fund manager, why would I choose large cap equities to benchmark myself against?
Yeah.
It's just such a harder benchmark to jump. Whereas if I was like a UK small cap
1.8%.
manager, 1.8%, like the alpha that you're generating and then the fees that you generate on that outperformance.
I know.
Anyway, different story for a different day.
Yes, but good question. Thank you, Daniel. I hope that has answered it for you. The takeaway as well is, as we've said plenty of times on this show, there are a number of good active managers who are coming to the market with listed ETFs. For active managers, the options are becoming more for us as retail investors, which is great. It is time for a new segment, one that I'm quite excited about. We're going to be unpacking the business of ...
Yes, we're going to look at some interesting business models and industries and try and understand how they work so we can become, I guess, more informed and better investors.
And today we're unpacking the business of NFL, but specifically driven by some news that private equity are now allowed to invest in NFL teams.
Yeah, so I think let's set the scene before we get to the news of the day. The NFL is the crown jewel of professional sports.
Yeah.
It has the highest valuations, and this isn't just in America, this is globally. The highest valuations and the largest ad revenue, especially ad revenue per game. In 2021, they signed a TV rights deal, 11 years, $110 billion. For comparison, this year, the NBA signed an 11-year, $76 billion deal. Now, we've pulled out the per game numbers because the NBA has 1,230 regular season games. So that works out to be 5.6 million per regular season game.
Yeah.
The NFL does 272 regular season games. So 36.8 million per regular season game over that 11-year period. So 7 times more than the NBA per game. Like, it is just crazy.
Yeah.
English Premier League second. Indian Premier League is also up there, but no one touches the NFL.
Yeah.
To put it another way, of the top 100 TV broadcasts in the US last year, the top 42 were NFL games or NFL-related programming.
Wow.
Yeah. So I think that is the context for this whole story.
Wow. Even higher than... Wow. Well, there you go. As I said at the top, the news is that private equity is in the game. Now, traditionally, NFL has required that owners be real people.
Yes. So it couldn't be a company.
Couldn't be a company, can't be private equity. It needs to be the big bad billionaires who can just come in and take ownership of these incredibly valuable sports teams.
Yeah. Side note as well is that the way it worked is that all other 31 owners had to approve the owner.
Imagine the politics in that.
Yeah, like the most exclusive club to get into.
Just a billionaires club. But now the NFL are allowing firms to buy a stake of up to 10% of the common equity of individual teams. Now, they must invest at least $2 billion. They must hold stakes for at least 6 years, which I think is a good rule to, I guess, avoid just trading in and out and pumping and dumping. And they're capped at investing in 6 teams. And the NFL has an approved list of private equity firms that can invest.
Yeah. And this approved list are deep in sports already because private equity has come for professional sports. Yeah. Some of the names that have been approved, to give you a sense of where they are also playing, Ares, which is like a $400 billion fund manager, massive. They've invested in Chelsea in the Premier League and Inter Miami, their football team in the US. Arctos has stakes in the NBA's Golden State Warriors and in the Major League Baseball's Boston Red Sox. Sixth Street has invested in the San Antonio Spurs and the Spanish football team Real Madrid. And Dynasty owns a minority stake in English football club Liverpool.
Yeah.
So they're global pro sports investors.
Imagine the lobbying going on behind the scenes for some private equity players to get onto that list.
Oh,
like
wild.
Yeah. I think it's very smart from the NFL to do that.
Well, before we talk about why the NFL would do it and what it can tell us about the business of professional sports, let's just quickly explain why private equity would do it. And this is where we introduced how good an investment professional sports has been. And we've spoken about it before. We'll speak about it again. So just to illustrate the point, I'll give you one example.
Okay.
Phoenix Suns, the NBA team, there was a private equity player, Dial Home Court Partners. They bought a minority stake in the Phoenix Suns in 2021 for $1.5 billion. When the team changed ownership in 2023, so 2 years later, Dial Home Court made an 158% return in 2 years. Yeah.
Wow.
So like the valuations of professional sports teams have been exploding lately. And a lot of it has been driven by TV rights deals, but it's just like, it's a scarcity premium as well.
Yeah, that's the thing.
You know, there's only 30 NBA teams. There's only 32 NFL teams. There's 20 English Premier League teams, but really you want one of the big 6. So it's just like, they're all so scarce and go up for sale so rarely.
Yes.
And every time there's a sale, valuations just jump.
Yes.
Yeah.
Scarcity, and now all they're doing is adding fuel to the fire with an increase in demand, with all these equity players now allowed to have a crack.
Yeah.
I mean,
so this
is only going to push things up even further.
In the NFL, but like in all these other sports, you're right. It's like this whole new pool of buyers.
Huge cash. Not like the billionaires ever had a problem buying them, but...
So this is where the story gets interesting, and it gives us an insight into the business of pro sports. Because you say the billionaires have never had a problem buying the teams.
Okay.
But these billionaires do have problems. And this move is
so sorry for them.
And this move is an insight into the problems that they're facing. Because a lot of these sports teams owners are asset rich but cash poor. That is the story that is emerging here, and that's what we need to understand about
The Elon
this.
Musk effect.
Sure, yeah,
Well,
yeah.
that was that. He's well known to be incredibly asset rich and like very cash poor.
Yeah. So
For context.
yeah, thank you. So to give you a sense, first of all, like these teams don't print profit. Like the way that
Yes,
they've increased valuations is capital growth, not dividends. To relate it back to all of our investing. To give you a sense, in 2022, the Walmart heir Rob Walton bought the Denver Broncos for $4.6 billion. And then a year later, 2023, Josh Harris bought the Washington Commanders for $6 billion. Now, Sportico have calculated the average profit for an NFL team, $137 million. So based on the Washington Commanders valuation, it's like a 2% earnings yield. So not a lot of profit for the price that you're paying for the asset.
Yeah.
You know, you could buy Commonwealth Bank and get like 5% dividends.
Yeah.
But these guys, So that's they're not printing cash, and that 2% earnings yield for the NFL is actually like best in class for pro sports. If we look at the English Premier League, we could get data from the 2021-2022 season. Only 7 of the 20 top flight EPL teams were profitable. And some of the biggest clubs make the biggest losses.
Yeah.
And that's because of player transfer markets.
Yeah. Not all billionaires are looking for assets to park cash that spin off yields.
Yeah.
Like you think what they do with property mainly property or other real assets. But there's so many other reasons you're buying an NFL team as well.
Yeah, it's prestige. There's some
getting in the
quote,
club.
that it's like there's the closest thing to royalty in America is a sports team owner. But the thing is, like, these are cash hungry businesses to run.
Yeah.
Because like just the cash demands on like how much you're paying. If you're doing guaranteed contracts now, you've got to like escrow that money, and so you need cash to do that. That's been a big story with the Cleveland Browns quarterback. But the problem is it's hard to get capital. So like the NFL, for example, have rules about how much owners can borrow, and they don't want too much debt. I think for existing owners, it's like 700 million cap. For new owners, it's like 1.2 billion or something like that. But you can't go to a bank and borrow against the value of your sports team.
Right.
So like that avenue is kind of cut off. And then it's tough to raise capital from equity investors because you can get individuals to do it. And like there's a long list of celebrities that have minority stakes in sports teams. But you know, you need the approval of the other owners and all of that. And then it's been tough to get, and there's only so many like rich people that want minority stakes in sports teams.
Yeah.
And then you haven't been able to go to these institutional investors like private equity because that's been blocked off.
Yeah.
And so that's the reason that they're doing this, because so many of these owners are asset rich but cash poor, and they've got demands to like renovate their stadiums and do all this stuff. And they just need money.
And so this is where they can go to the private equity guys now and say, what was it, up to $2 billion?
Yeah,
is
up to
what
$2
they
billion.
can invest.
Yeah.
Take a stake, give us the cash.
Yeah.
Let's get on with it.
Yeah, and Greg Penner, who's the chair of Walmart and part of the ownership group of the Denver Broncos, he explicitly said it. There's this quote where he was like, it gives owners a different option for capital sources, and then like blah, 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 maintains how we operate, core ethos, all of that. But like that is the game.
Yes.
A different option for capital sources. That's why they're doing it. And I think as we close this business of out, the best example of this is actually not from the NFL,
Nice.
but from the NBA.
Cubes.
Mark Cuban.
Yeah.
So he bought the Dallas Mavericks after he sold his company,
business or
broadcast.com,
whatever it was.
and then
Yeah,
shorted
yeah.
the shit out of it and doubled his money.
Yeah.
Different story for a different day. But he bought the Dallas Mavericks and loves the Mavs,
Yeah.
loves them so much. Courtside every game, is seen as one of the best owners. But he sold a majority stake in the Mavs.
Yeah.
And the reason he sold it is because the demands of what professional sports is going to require, and his sort of view on where it's going is that right now the majority of the money they make is from sport TV rights, but over time he reckons it'll be more from real estate and sort of like associated services around the stadium.
Yeah.
And he envisages like a Las Vegas style resort and entertainment destination in which the stadium is just one part of it.
Right.
So you go to like Mavs Casino
Big
and you
money.
stay there and you watch the game, but you
Yeah,
also
yeah,
do
yeah.
a whole bunch of other stuff. And to be frank, he doesn't have that kind of money.
Yeah.
So he sold a majority stake to Miriam Adelson, who is the owner of the Las Vegas Sands Resort.
Yes.
Because they've got that money.
Yeah.
Yeah.
And managed to keep ownership control as well.
Yeah, he's got 27% stake, but
Yeah.
he maintains control of basketball operations.
Yeah.
Yeah.
Amazing deal.
Yeah.
Fascinating what's playing out. I think the caps around it are interesting in that it shouldn't change the way that the clubs are run and the demands on it.
It won't. Yeah. It shouldn't. No, you wouldn't think it will change much, but I think it's an interesting insight into how these businesses operate. Don't feel too sorry for them.
No, I don't. No hard, nothing at all. Anyway, that brings us to the end of today's show. A reminder, if you want to keep up with the daily news headlines, to sign up to our daily newsletter. Link will be in the show notes. If you want to leave a question for us, head to equitymates.com/contact and leave a voice note and we'll get that on the show. And if you're really enjoying the show and getting a lot of value out of it, we would really appreciate if you could take 2 minutes to leave a review and a rating in your podcast app. But Ren, as always, an absolute pleasure to chat stocks and markets and all things business.
And we stuck some sport in there
And we
as well.
snuck some sport in there. We'll pick it up next week.
Sounds good.
Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.